Greetings, Dr. Jeffrey Scott, and this is my weekend market update for the week ending on Sunday, November 17th, 2024. I'm actually doing this much earlier in the weekend than I normally do because the weather outside is outstanding here in South Florida. The humidity's down, the temperature's great, there's no rain. I'm going to go out on my boat. I titled this one All Eyes on NVDA Earnings as Markets Correct from Post-Election Euphoria. This was a tough week. I mean, when you compare it to the week of the election, we'll take a look at that. But one could make a case that we're at a point that's a pretty obvious place to bounce if we can hold the retest. And if we don't, then we've got NVIDIA earnings coming after hours on Wednesday, and I think that's going to really determine what happens, whether we bounce early in the week or not. NVIDIA comps are going to get tougher. Their growth is slowing down. Hard to continue to grow at the pace it's done. And if the market doesn't like it, does it pull the rest of tech and the markets with them? And if they beat, is it off to the races? It's funny. This part of the year is usually a strong part of the year, but I don't know if it was 2018 or 2019. I remember we had a year where we actually sold off into Christmas Day. So there's no guarantee that the markets go up at the end of the year. So we shall see. Thanks for joining me. My email address is htsIdoc@gmail.com. If you're new to my channel, hit the subscribe, hit the alarm, and you'll find out when I post these. If you like what you see or don't like what you see and you have constructive criticism, either way, why don't you go and put some comments in the remarks section or just email me. And if you like it a lot, hit the thumbs up so other people can get exposed to this as the YouTube algorithms actually look at that. I do this every week, and I'll talk more about some other options for getting some entertainment and education from me. This is for education only. Anything I talk about should be taken in the spirit of education, not investment advice. The intent of this video is how I use the tools of top-down analysis and how I apply them to my daily trading. Trading involves risk. You and you are solely responsible for any investment decisions you make. You have to assume that any stock I talk about I might own, I might want to buy, I might want to sell, I might want to sell short. So I'm not going to say it about every stock. So, I could be trading the things that I talk about. Trading stocks and options should be considered risky, and you should consult with your financial advisors before making trades. I have tools for multiple platforms, but I'm an independent trader. Let's talk about that for a second, because I get a lot of emails asking why I do one platform or another. I use a lot of platforms. My tools are in wealth charts. Thank you to Rob Hoffman for putting them in and building me a great scanner. They're in TradeStation, different scanner built by Van. Pros and cons of everything, both of them. It's in TradingView where Praveen built me the indicators. It's going to be out soon in Metastock, and that way it'll apply to markets outside the U.S. because they have data U.S. and X, and they also have a wonderful charting and scanning platform. And many of you are aware that I'm developing a freestanding app. So I use a lot of them. I still use all of them. I use wealth charts predominantly on the weekend videos because that probably has the biggest distribution of people that use my tools. I'm going to introduce you to something in the next slide, which is another alternative. If you have a platform you like to see me use, if you want to see me vary the platforms, let me know. Comment sections, emails. I stick with one because I'm a big fan of rinse, wash, repeat. And therefore, if I'm going to show you over and over again how I do the same thing every week, it's good to stick to one platform. But for those of you who have other platforms, I think there's alternatives that I can do for you. Speaking of the alternative, I have started a Google group. It is free. I will not be soliciting you for money. There's no different level of platform, whether you pay for it or not, and there's no requirement that you own any of my tools. How do you join it? You sign into Google Groups. You find the one called Top Down Trader. You sign up for it and pick whether you want just a synopsis every day or emails when I send them. Why would you do that? Well, if you like what I say on Sundays, why not hear about it more frequently? I do post comments during the day and after the markets, charts to show you what I'm thinking. I do videos that I post there of the app, the TradeStation video, different things that I can do to do my analysis. And it's also a two-way communication opportunity. So I just launched it. I had a small email list, and to be honest, I was getting tired of getting a list every night showing me that all the Gmails were bouncing from my email list, which I was sending from a Gmail address. So just figure that one out. So think about joining Top Down Trader, and there's no expectations that you buy anything. Now, will I offer things there like private webinars? Yes. Will I offer discounts on my tools? Yes. Will I introduce new things there? Yes. But I'd love to have you join. And again, there's no commitment necessary except to sign up. If you do like these videos, I do, again, courtesy of Rob Hoffman, do place a wealth charts video most mornings at stocksanddocs.com. Because of my work-life imbalances, I often do them later at night, and then Rob's team posts them for me first thing in the morning. It's got to start with the major markets, and if we compare this week to last, there are major differences. Last week, everything was green. We had outsized returns. The world was awesome. Things could get no better. Well, they could get a lot worse, though. And they did this week. And we haven't reversed the Trump bounce. We did have some toughness in the market. We're going to look at it. You could see, hold on one second. As you can see here, we have a lot of red. The only things that were up were Bitcoin, and boy, was it up almost 20% off of a big number. Natural gas, which has really been dead to most of us for a long time, can't get above its 200-day moving average, which has been a kind of like putting a blanket over the stock. Dollar index was the other, and that's never great for stocks. You could see the Dow and the NYSE were down 1.3, 1.5, 2.1 on the spiders, 3.2 on the NASDAQ composite, and 3.4 on the Qs, and 4% on the Russells. So sort of a reversal, at least 50% reversal of what we saw the prior week. Now, you get corrections. It's not to be a shocker. I think we had plenty of signs of that we've talked about, worsening breadth, Hindenburg omens, some divergences in stocks, and some of the breadth indicators. And then we also had the implication that we knew coming into this week of CPI, PPI, and a lot of Fed heads. And I think the Fed talked down the likelihood of a rate increase in January, February, and March. At least that's how the market responded. So we'll look at the indices. Friday was a down day. It's interesting. I was watching my short-term portfolio, which is a lot smaller, and it actually recovered a lot during the end of the day. So I went and looked at the indexes, and I was a little surprised that they were still down. When I saw that intraday reversal, I thought, well, that's what I would have expected today. But we didn't get it. And that bothers me. In fact, after such a bad day on Friday, of which it's not uncommon to see a reversal back to the mean because people are getting neutral before the weekend. Will we open down big on Monday and get the reversal then? No, it wouldn't shock me. If we look at the ETFs, you can see led by financials and energy and utilities. Is it time to start looking at energy? Certainly has been the laggard. Certainly been the laggard. And if you look over here and you look at how things have moved off their 52-week lows, everything is up, even energy. But you can see energy and staples, materials, healthcare have been the laggards. What about the health of the market? I'm going to look at it with multiple different tools. In the PowerPoint, I use a lot of tools. When I actually go into charts, live charts, I use wealth charts. Why do I use so many PowerPoint slides instead of going into the various programs? Because it'll take too long to switch. If we look at the Q Edge tool from Sagar-Nandy, SuperiorProfit.co, you could see that on Friday, 82% of the sectors were down, 74% of the industry groups were down, and 68% of the stocks were down. So that's a negative session. Now the interesting thing is 59% of the stocks are still above the midline of their Bollinger Bands, and that's still a longer term or intermediate term bullish. So we've pulled back, certainly in the short term. This is not a horrible bear market at this point. If we look at the buckets, you could see we still have more stocks above the midline. That's what it says over here. But we got very few stocks at the top, and we're starting to build the stocks at the bottom. So definitely some short-term weakness. If we look at the last 2 weeks and the last month, they look a whole lot better than the past week. So we've really had 1 week of weakness. This is the Q Market Breadth tool. Kind of what got me excited by Metastock, to be honest, is what Sagar did with it. This is a Sagar-Nandy SuperiorProfit.co tool, and he's got as good a way of looking at breadth and some of the signals that Ian developed that I use and I've talked about for a long time. So let's just spend a few minutes on this chart. Market breadth chart here shows me here that in yellow, stocks above the 50, above the 200 have dropped, and white stocks above the 50 have dropped, and then the orange is 50 above the 200. Here is a D line, it's deteriorated, up-down volume has deteriorated, and new high, new lows have deteriorated. This view is a combination of the NYSE and the NASDAQ. This is the key here, 3 days of Hindenburg omens together. This here is the 50-day moving average. You can see this composite is coming down to the 50. Why is this important? Because this is something that has historically been an area where markets have bounced from. It's been resistance from on the move up. This one and this one shows that it doesn't have to hold. This here is a 13-week new high, new low. You'll see that on a lot of my charts. And why is that important? Because boy, when it gets to the top, the markets almost always come down. When it gets to the bottom, they almost always go up. And what are we doing here? We're approaching the bottom. We're just not there yet. If I break out the NASDAQ and the NYSE, you can see the NASDAQ's getting pretty close to the reversal zone. It's also pulling into the 50 here. So, is the NASDAQ one good day down or 2 good days down from a 50-day touch and a bounce? Certainly could happen. This is not the Qs. This is the NASDAQ composite. Similar thing could be said by the NYSE, although the 13 weeks not there yet. If you look at both of them, you could see the magenta Hindenburgs, which means they're confirmed Hindenburg omens. A few comments about the Hindenburg omens. They are historically defined on the NYSE. I've done a couple of recent videos and reviews that in my mind suggest that I should be looking at them on other indices as well, especially since if you think about the components of the NASDAQ, tech-driven is very different than the components of the NYSE, energy, banks, etc. They're very consistent here, except the NASDAQ is getting closer to the usual bounce area. If we look at the major indices, again, here's the NASDAQ 100, it's not quite down to the bounce area. Here is the Russell 2000. You could see all of them are trading above their 50, but all of them have had a reversal off of, except for the Russell, all-time highs. Here is my trading app. You can get the same view in Wealth Charts or TradeStation. The difference is Praveen programmed in this line at the bottom. The bongo is up at the top, and I'm not going to go into how you do buy sells. I've done that enough times, and I don't want this to be a really long video. This tells me we've been in a buy since down here. We are still in a weekly buy on the Qs. We're still in a weekly buy in the diamonds. We're still in a weekly buy of the Russell. So even though I am more concerned about the market right here, the major dominant trend is still up. So what does that do to me? It means I'm less likely to bail on my longer term positions. But when I look at the daily model, you could see the Qs have now gone to a sell, and we are close to a sell on the spider as the bond goes red, and we're sitting right above the WMA. We haven't flipped. Yep, same could be said on the Russell. The one that's furthest away from the WMA is the diamond. So the Russell's close to a sell signal as well. So short term, weak. Long term, still okay. Raise cash. This is how I handle it. I'm not telling you what to do because I don't know your investment objective, how much money you have, and how much risk you can take. What I do is when I start to see the short term weakness, I start to I tighten my stops and let the market close me out on a lot of my short-term positions. I raise some cash and I get ready to pounce when we get a reversal. When everything is aligned in buys, I've got much more cash in the market, maybe even some margin. I'm not in margin now. Have I started buying contra ETFs or shorting? I'm close. But I still think we're at a point we could bounce, so why would I want to do a lot of things to the downside except for maybe a hedge? This is one of the views from my trading app, and it's updated real time in the market. And I just want to show you that over here, all of the stock indices, which is the top four, finished in the bottom part of their closing range. We've seen that over the last several sessions. That's weak. The VIX was up quite a bit, not good. You could see the new high, new lows from every time frame have turned red. If you look at strength in the market, utilities were up 1.5%, financials and real estate on the 1 day. On the 5 day, look at energy and you look at financials as the leaders. You want to see what got killed on 5 days? Healthcare just destroyed, 5.55. Technology 3.56. Materials 338. So it was a really tough week. What I have here are themes. And I look at these themes to give me a sense of what's actually leading from an industry perspective. And you could see on Friday was sort of reversion to the mean as some of the recent weakness in cannabis and clean tech came to the top. When you look at over 5 days, you could see that cannabis is actually now positive. It was down immediately after the election. But clean tech is still down. China is still down. Not big fans, I think, of the results of the election. Over here, I take those bucket analysis that Sagar did, and I do them as well on the NYSE and the NASDAQ, seeing the weakness, the number of sectors up, where it was the prior day is the gray bar, industries up versus the prior day, advances versus decliners, and then how many stocks are above the midline. And we've dropped below 50% on the NYSE and the NASDAQ, so they're definitely weaker. The fact that I can get this updated real time with a single data feed, not requiring multiple programs or any external data feeds, was partly why I built my own app. Built my own app. Thank God for Praveen. Praveen built my own app. If we look at the rates, they rose in white. You can see the 10-year was up 2.83% on the week. The 30-year was up 2.77. And I think part of it is inflation is sticky and employment is fine. So why would the Fed need to cut if employment's fine and we still have inflation? And I think the market started to realize that. And so, you might think that banks, insurers, and regionals might get strong again. And we certainly saw financial strong on Friday. Is there a recession in the near future? I know I say the same thing every time. There's always a recession. You could see here the gray bars after the normalization of the yield curve. Here's a 10 minus 2. Here's a 10 minus 3 months. Pretty much always get a recession after normalization. The recession lags. So I've been thinking it would be really make sense to me for that to happen at the inauguration or after the inauguration. But we'll see. No signs of credit tightness, and we'll get this updated on the diffusion activity. Will be updated in just a couple of days to see if we still have an active manufacturing. Breadth eases, but it's not oversold. Stocks above the 200, stocks above the 40-day, both eased. Here is the Warden interpretation of the 13-week new high, new low. And I've been following this thing since the last century. And when you bottom out, typically the market bottoms. When you get to the top, typically the market pulls back. We are not at a point where we have a guaranteed reversal. Speaking of points of reversal, this is the bucket analysis in EdgeRater, similar to what I showed you in Sagar's tool. But what I wanted to show you was this is what a really over hot market looked like, and this was on November 6th. Think about it. What day was the election? The day before. We had over 40% of the stocks in the S&P 1500 were above their Bollinger Bands. Is there any surprise that this market had pulled back? That is not a normal figure. It's not a sustainable figure. And even though the market held on okay on Thursday and Friday the prior week, it started to come down even before the market corrected. In my app, I've got the NYSE, the NASDAQ, the Russell, and the S&P 1500. The gray is yesterday. I can tell you a week ago, but I've turned that off for the simplistic, make it simpler to talk about. The red and the green are the current day, and you could see we've certainly shifted to the left, which is a much weaker looking market than we were a week ago, and we're starting to build up the stocks below the Bollinger Bands. A good flush at the open on Monday might be what it takes to get this market to reverse. And then again, we also got NVDA earnings late in the day on Wednesday after hours. And boy, if they're bad, look out. Heed the Hindi. I'm a big believer in the Hindenburg Omen, and we've been seeing a lot of them of late. Typically, they precede major market declines. They're not an immediate response. Now, 1 out of 4 signals, and this is a constellation of signals, but certainly we have a new signal going on. Probably had one here in October, and now we're still dealing with this one here. 1 out of 4 is a big sell-off. The others are minimal. I remember going into the end of 21, we were seeing the same pattern, and I wanted to ignore it because it was mostly on the NASDAQ, and the market seemed to be holding up okay, and then the markets plopped. So I heed the Hindi. Markets turned down. This is kind of the inverse of what we saw last week. When I take all the stocks above $2 and 250,000 shares, and I give them a value of ERG, which is EPS rank plus relative strength rank plus group rank, and I look at performance, you could see that pretty much if you throw out the tail, because there's very few stocks, throw out the head, because there's very few stocks, you've got a trend towards performing worse in the higher ERG. So high growth stocks underperformed. You could see here earnings per share didn't matter. You did poorly throughout. And look here, higher relative strength stocks, which should lead, lagged. Stocks that were in the higher groups lagged. So we had rotation out of growth last week, out of high growth. And then ARKK, which is Tesla driven, still did okay, but the IBD 50, the small cap growth ETF, really tanked on the week. Know your news and earnings. So on the left, you can see we still got plenty of Fed heads. I think their mission now is to talk down the rate decrease enthusiasm, and that every time they do that, the market seems to sell off a bit. Perhaps we've now priced in not having a rate cut in December. Personally, I think they're still going to cut in December. I mean, maybe that's just wishful thinking. But I think after that, it's going to be really dependent, and they do have some more inflation numbers before we get there to look at. On the right, we still have some earnings, and I highlighted some of the keys. I didn't hide everything. Lowe's, Walmart, Target, big names in the retail space. Powell, which I didn't highlight, has been a big leader this year. It started selling off a bit, and it's in the electrical component space. NVIDIA, that's the king. Palo Alto and Snowflake, so it's a big tech Wednesday afternoon. So I think it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. My largest position is NVIDIA. There is no question when after last earnings it dropped from 140 to 90, I took a major hit, and I questioned whether I should have sold it. Even buying puts was expensive, but it's a long-term position. My costs are much lower than it is, and I held it. That was a judgment call. I don't think it was a mistake because in hindsight, it's come back to where it was and higher. But had it never come back, it would cost me some money. But I treat long-term money different than short-term. Going into earnings, if I don't have a significant gain, boy, I'm probably not going to hold through earnings. I think it's going to be a market-moving event. So my thoughts, we hit, you know, the week before we had record highs. This week we came down. The week before, mega caps and chip makers did great. This week they came down. Healthcare got clobbered. I mean, I'm in healthcare, and you know, even though I'm probably, not to be political, center right and mostly conservative, when I think about politics, especially the economy, I think if there was a thing called social democrats in this country where fiscally responsible and conservative and to the left on social issues, that's where I would find. Healthcare is broken in this country. 18.8% of our GDP goes for healthcare. We are nowhere close to good in survival compared to other first and second world countries. We spend multiples of what all of them spend, and we don't do as well from a life measurement. And if you look at 1 year mortality, we're not even at near the top. So you can't spend that much money in a place where the debt has gone crazy, have tons of uninsured and bad outcomes. I'm not sure Robert F. Kennedy Jr. is the answer. Shaking up the system and starting over when you spend that much money might be the answer. So even though I thought that's an interesting choice, maybe a little wacky, we need to do something different in healthcare. We can't afford it and not have best outcomes. Hey, I'd be okay if we're spending 25% and we all live to 130, but that's not what's happening. Interest rates and concerns, I think, are driving this market down. The dollar's not helping. Growth stocks led the decline, and fresh sell signal on the Qs is making me pay attention. We'll see what NVIDIA does. And I mentioned the multiple Fed speakers. Again, consider joining my top-down trader group. It's free, and I want to create value, and it gives me a chance without confusing people to have lots of educational videos using different tools and not disturbing the audience here that's mostly wealth charts. On to the charts. So that part went longer than it usually does, but that's okay because it is not like I'm going to show you 1,000 charts to buy. I think there's too much market risk here. So first I want to start with the Trump bump. And I didn't realize that rhymed. Here is where we closed Tuesday before the election. Like many of you, I'm watching TV, listen to the futures, listening to what's going on. And I think as soon as it was clear that the Senate was going to likely move to the Republicans, the futures took off. And when we opened the next day, not only did we know that Republicans got the Senate, that Trump won, and you had a major gap up. A little bit of a pullback, and then the market just ran up. Wednesday, Thursday, I'm looking at the spiders as a surrogate, and Friday. Then we got this week. Monday, we sold off a little bit. Tuesday, we sold off and recovered. Wednesday, we tried to gain, but couldn't hold it. Thursday, bad down day, and Friday, another bad down day. We ended up almost, frankly, if you look at the low of the first hour and the close, we ended up at the same place that we did at the gap up. This would be a natural place to hope it holds. However, if you look at the Russell, it did not hold. If you look at the diamonds, it is at that point right now. So, will we hold? Don't know. But this is the first line in the sand. Filling this gap is going to be painful. If we look at all the different ETFs aligned together, you could see the sell-off into the end was pretty much consistent everywhere. If we look at the daily spider, you could see that, let me see, I did some moving around here. This line here, this prior high, and I think that may have been, I can't tell if that was meaningful in the back. We touched. What's next? This prior high here is where this box is drawn. Probably make that box a little narrower. This is the 50. So if I had to guess what my target would be if we don't hold here, which is the prior breakout area, I wonder about the 50 and the top of this area in here. If that doesn't hold, we've got this linear regression line here, and then we have the 200. So we have lots of areas underneath that we could get support. My hope is we bounce off here. If not, I'll be looking at that 50. If we look at the weekly spiders, does it look that bad? Does it look that much different than here or here or here? And these were all reasonable sized pullbacks in an uptrend, and we kept going higher. Hence why I haven't started trashing my long-term positions. And in fact, if you look at a monthly chart on the S&P, the spiders, it doesn't look bad at all. So I don't want this to come off as I'm Dr. Bear, everything's horrible. I just think we're at a part where we have some risk. If I look at the daily Qs, have broken below the breakup point, and then you can see here, closed below it. So they've already broken down. Where do you think my target is on the Qs? The 50. How far away is that target? (1.5%). It's certainly something that could happen and could happen as early as Monday morning. That'd be a great place to pull back and bounce and close higher on the session and give us a reversal bar and a bullish engulfing pattern. Who knows? What about the diamonds? Let's look at the weekly on the Qs. I've not taken out the prior bar. So yeah, it's a bad week, but it's not the end of the world yet. Diamonds, as I showed you before, they are sitting right at that breakout area. Again, the natural place, which also corresponds with the high back here, the natural place for this to hold. Well, what if it doesn't hold? I got a trend line coming up and a 50 underneath. That would be my next target. Let's look at a weekly on the diamonds. Doesn't look that bad. Let's go to the Russell. The Russell is the only one that is yet to make a new high, and I have a box somewhere on this that reminds me their all-time high was 244.61 the week of November 8th, 2021. Nowhere close. And this one did not hold at this line. And now you got to wonder, is it coming down into this area, which was resistance before? And let's see if it holds its support. And where is it sitting? It's sitting right there, give or take. Natural place to bounce. If not, it's going to come down to here to this 50. So I think that 50 is a valid target to look at. Hopefully we bounce before then. Maybe we hit the 50 on Wednesday, and then we get a positive NVIDIA earnings and we pop at that time. I mean, wishful thinking, of course, especially since I'm long NVIDIA. At least I am right now. And you could see, is that a horrible looking bar? Is it that much worse than this or this? These all occurred in an uptrend. All right. So that's my look at the markets. I've already showed you my timing model. For those that don't believe me, I can reproduce it in wealth charts, the same charts, I just don't have the signal line. All right, now let's look at the hourly sectors. So the big leader right now is financials. I saw that on my looking at 1,000 charts last night. Communications gave up a little bit. It's been strong. Energy is up and coming. Um, Industrials is holding up okay. Technology gave up some. Staples, real estate, utilities, trying to make a stand. They're defensive. No surprise if this market's going to sell off hard. You might see them outperform. They pay dividends. They may not be as extended as some of the tech-driven stocks. Discretionary is holding up pretty well. I took its star off. I could have left it. Healthcare has just been hammered. And on Friday, biotech didn't do well either. So there's a lot of weakness here. Look at materials. The other big star is Bitcoin, but that's a whole different story. So next thing I do is I go into my stock scanners and I go into the heat map and I look at what the S&P did on Friday. Now, as I tell people, sometimes the percent change for Friday and what they show when you hover over here in the heat map are different, and that's because the heat map looks at after hours. So could you see something like this on the market Friday after a big sell-off, a big bounce, opened below, traded a little bit down and closed at just off the highs? What Tesla did? Absolutely. So Tesla, there's a lot of stocks in the U.S. market that look just like that. Stocks that were big runners that have pulled back the last couple of sessions, and then despite the market being tough on Friday, had a big green candle. So there might be some things to look at. But I would be careful here because most of the performance that you're going to get in your portfolio over the next week and days and months is going to be how the market does. So the reason ARKK was up on Friday was because Tesla had a big session. NVDA pulled back to the 17, did drop below, held there, positive retest. I think NVIDIA is all about NVIDIA earnings. And I don't think it does much, maybe drifts lower into earnings. Amazon pulled back into that 17. Is this broken down? Absolutely not. I'd wait till I had something above, a green candle before I got too excited and chased. Meta, this one broke down below the 50. That to me is much more bothersome. In fact, it had an EMS short-term shorting signal. It had high volume on a down session, a breakdown, momentum, downside, PSER reversal, Bongo daily reversed, relative strength and OBV are dropping. I mean, I wouldn't, but this one's potentially even shortable here, especially if the market was to sell off. Microsoft, another breakdown. Similar pattern, maybe not as bad on the volume. And I'm not recommending you short the strongest stock in the market of late, which is Meta. Apple's failing at the 50. I think more than anything, I'm just showing these things are not healthy. AMD has broken down below its long-term trend line. Not good. Lilly, which is seeing probable competition for GLPs, they're not going to be here for a while, but it looks like it's done. I certainly would have taken some profits already. Google. Now, by the way, I don't think Lilly's done. I just think Lilly got ahead of itself. And any bad news is going to take it down $100 here and $100 there. Google still holding, but in this short pullback, did not get much of a reversal on Friday, but it did close off its highs. And a big leader was Disney with great earnings. Here you could see a 3% beat, but their streaming numbers look good, and the street was very happy. And look at this, on a bad day, they opened at 110 and a quarter, which was 8 cents below the close after the gap up and the low of the session. Very strong day for Disney. And lastly, in the MAGs plus Netflix, wow. Yeah, it had a bad day on Friday, but wow, Netflix driven by great subscriber news, especially in the advertising area, um, really is on fire. So mixed bag on the mags plus. Um, are there any that are real actionable right now to the long side? I don't think so. I think maybe after a little bit more pullback, you might get some opportunity. If we look at the wealth scanner, we get a sense of what's moving in the markets. And I look at how many are above 800, and I'm going to tell you it's come down quite a bit. And then I look at what's leading. XLE is number one group right now. That just tells me it's moving up. The financials also moving up, but they started from a higher place. Software is still strong. MLPs, and I saw several of them. And this is a group that I like because to me it pays a dividend and gives me growth. Now I'd rather buy them at a discount than at multi-year highs. And the one that I own, and I've talked about, gosh, for years, is ET. And the reason I own this is that update. Here it is. It's got a nice uptrend. You can see it over here on the weekly, but it pays a 7.8 or so % dividend. So I get a little bit of capital appreciation on the stock side, but it really is nice on the dividend side. You can see we now drop below 800. Israel, infrastructure, the dollar. Never good when you see the dollar there. I guess it is good when transports are doing well, and maybe they'll pull the rest of the market with them, and they're in that little flag after a big gap up and a little big move up. All right, so the tool that I've had developed in wealth charts is called the CAT scanner. I am a physician, although I don't practice, and a lot of my physicians probably don't like my views on healthcare because if you're doing well as an individual, no one wants to change. I just think we got problems in this country, and healthcare is part of it. Not to be political. But I've built a tool to find my favorite types of stocks. My favorite types of stocks are stocks that are in an uptrend, pull back, and then have a new momentum come in and a breakout and start into a new uptrend. So that's my pullbacks. I have an equal model for retracements. So I put together a week that I post on my top-down Google group every week of my pullbacks and uptrends. You can see there is only one with 4, and I'll tell you what the dots are, a couple with 3, and 2. Now, that's not a very bullish list. Usually there's a lot more. I have 4 dots here. When I've looked over time, I get the best move in the markets when the dots align, I break out of a moving average, and I have a pattern that I like. So I use the dots not as a signal to buy or sell, but to make me look at charts. I like to look at relative strength versus the spider and being above the moving average. I like to look at OBV versus a moving average. So I put a number of things together when I look at a stock. And this red line is my extension oscillator I call the high-low jump. I don't buy when it's above 95 except in a rare circumstances, and I go with eyes wide open that I'm buying an extended stock, and I don't short when it's below minus 95 because we're at a place where you expect a reversal. So in the long, actually before that, let's just open up energy. Since XLE has such a good score, we should look at energy. And let's see if there's any pullbacks and uptrends. So interesting, I think most of these are MLPs. That is bizarre. MPLX is the one that I like. Nice uptrend, pullback, and a breakout. Now I go down here, it's at 86%, so it's not too extended for me to buy. So as I go down 1750 and a 200-day moving average, the diamond is a Rob Hoffman launch indicator. The circle is a wealth signal, buy or sell signal. The triangle is my proprietary EMS signal, which will fire most of the time earlier and fired back here. Regular volume bars, my four dots, gap, volume, breakout, momentum, squeeze. When the squeeze line turns green, it's come out of the squeeze. That's when you buy them. You don't buy them when they're going sideways. Relative strength versus the moving average, OBV, and the high-low jump. So this one doesn't look bad. It's just probably too far gone for my taste. One okay. Wow, this is the pullback. And hopefully we're going to see a signal. Yep, look below. Came out of the squeeze, two dots, relative strength and OBV. Now too far extended for my taste. Coterra Energy, I think this might be a producer. Got to get above the 200 to get me excited. E-Link Midstream, breaking out, going higher. Kinder Morgan, big move up. And could you have found it here? Let's see what pops up. Look at that. Four dots, relative strength and OBV look good. And it would draw you to it and say, ooh, it pulled back and it just broke out. That would have been a good looking buy signal. And then Williams Companies, another of the MLPs. MLPs are strong, but I'd rather buy them on pullbacks, and everything pulls back eventually. So that's where I would start. Now, I have something called All the Momentum Up. So it picked in Bloom Energy. And what I could tell happened on Bloom Energy, for whatever reason, there's no news button there. It's the earnings they missed. But they signed a deal to provide energy and something to do with Bitcoin miners, which use up a lot of energy. There are your MLPs. CVR is a refiner, kind of beat up. DT Midstream is another MLP. And you could see, and we've talked about these things a lot because I like big dividends and growth in the same instrument, and these have them. All right, so not a whole lot here looks very buyable. VLO, another refiner. Are we going to go from the summer to winter changeover when refiners start to hum soon? In fact, let's go into seasonality. Just curious. And let's pull in that energy list. And let's look at who's got bullish seasonality. I'm going to change that to bullish over the next 4 weeks. Halliburton, 8% move in the next 4 weeks. Now let me adjust my dates here because we're not in August anymore. Let's push this here to the 20th, which will happen this week. And keep moving out about a month to Christmas time. So Halliburton over the next 4 weeks averages an 8% return, and then it sells off. And that's why in this period of time from November 20th to December 25th, it looks like a 50-50 averages about 2%. Or any of those MLPs here. So, there are some stocks here. RIG, another in the services section. 6 wins, 4 losses, average return of 9%. Does better in the next couple of weeks. So there is strength, especially in oil services right now. So let's go back to my scanners. And let's see, how about, let's go, any rockets here? Rockets are things that had a big move. And you can see CEIX is an example of one of my rockets. Now, I don't like buying stocks until they pull back, so this is one I might be watching on a watch list to see if it gives me a good buying opportunity. And again, at the top of the list are all my MLPs once again. Let's go back to my combo buyers list, which is a large list that I create from a lot of watch lists that I do in TradeStation, Thinkorswim, websites I download from, scans and wealth charts. I add all the stocks that are bullish, and I throw them in this so I could screen them. So Despegear.com, this is the definition of something that had probably good earnings, up 88%. Now, massive volume, breakout momentum out of a squeeze, relative strength LBV look good. It's just extended. Now, do I expect this thing to go higher from here? It probably will. But the question is, does it go straight up? Kind of like Disney it looks like it wants to do? Or does it do this? And then break out of a flag. That's my guess. And so what I would do is probably put this on a list and watch. Alcoa Corporation had a gap up here. Great volume. Not extended. Relative strength and OBV look good. It's just getting into an area of prior resistance. AXNX, Axonics, I like this one a lot. I'd make sure this isn't a buyout the way it's so stable here. In fact, let's check that right now. The easiest way for me to do that, I think, is to just go into HGSI, AXNX. Let's go look at AXNX. And the only reason I'm going to HGSI is not for the charting platform, although it's great and it's got some great top-down tools that I've been using for years. Because if I right-click and I go to more info from the web, FinViz, it's going to open up right in there. See, that looks like a takeover. Let's see. Boston Scientific closes acquisition. Yep. So Axonics, which is a beautiful looking chart, forget it. Here is that CENX, Century Aluminum. Like Alcoa, that's two aluminums in the top when materials have been weak. Might be interesting. But again, do I buy it now because it just broke out? Maybe I do, because this was the post-earnings excitement, 63 versus 27 cents. Here's that exact type of a pullback I said, and here's a breakout of the flag. I don't like that it closed in the bottom of the gap up bar. I would go do some research on the news, but that's two aluminums of the first four stocks. That's interesting to me. CMP, Compass Minerals. This is one that I think is buyable. Now, you're buying a laggard. You have to keep in mind of that. And it's probably a turnaround. Why do I like it? Because it took out the 200 decisively. I don't care about the high-low jump. How is this extended? All the moving averages of the price are in the same place. It's just a mathematical thing when the stock has been sideways here. Massive volume, breakout momentum, out of a squeeze, bongo flip, PSAR flip, and relative strength and OBV look good. So if I wanted to find something that's not a growth stock, that actually had a good session in a weak market, this is going to go on my buy watch list. Cybin, don't know anything about CYBIN. It closed below the 200. It's interesting. Let's see. Earnings were horrible. There's got to be a story here, and I don't know it, so I'm not going to look at it. Kingsoft Cloud Holdings. We know that software cloud is high. It's a cheap stock. Next. You want to see a leader? Woof. Woof. Smoking. Now, look at that high-low jumps at 100. This is Palantir, PLTR. And this is a stock that did nothing for ages. Cup and a handle and a breakout and gone to town. Too late, in my opinion. This thing probably goes higher because I said that. But how do I buy a stock that's extended? I got to look for a pullback like this. Like this. Like this. They happen, and maybe this was one right here. But considering the overall market, tough for me to be chasing. Perpetual Research Corporation, no idea what they are and what they do. Let me pull up that. Actually, let's look in TradingView. I think that's open. What was that? PPTA? PPTA? NASDAQ? Precious metals, non-energy metals. I wonder if this is another aluminum play. All right. AT&T. I like this. I'm in it. And I think this might be an interesting place to buy more. Earnings, little bit of a beat. Sideways move. So you're basing. You're coming out of a squeeze with volume, breakout, momentum, relative strength and OBV, not extended. To me, that's a beautiful stock. Are we in an uptrend? Absolutely. Did we pull back? Certainly a sideways pullback, and it looks like we're breaking out again. Again, this is a defensive play. Pays a 4.9% dividend. If this market continues to be choppy and you want to be invested, that's why I'm in it. APMP, the monster stock, even more than Palantir. And boy, I've been in and out of this. Sometimes you wish it was a long-term holding, not short-term trades. But boy, putting in a flag up here, the extension came off with the flag. Great relative strength in OBV. This is the boss of our era right now. You'd have to put your stop, I think, below here if it was me. Um, it's a, it's just a boy. It's a extended stock by most means, although the math looks better. Big doji here at the top. I think it's at a point now where you'd be chasing. DAR, Darling Ingredients. Um, I don't think I ever liked the fundamentals of this company, what it does. It just broke out above the 200, a little bit of pullback here, good volume, breakout momentum, relative strength and OBV look good. I like the weekly. Again, I think they do something with food oil, and it's been in a long-term downtrend, but that's a fresh breakout above the 200. So we could go down this whole list. Other financial stocks that look good, and I'm not going to go the whole list. Bank of America breaking out to a recent high. Um, BlackRock, they own America. Little pullback setting up to go higher. We looked at Disney. And then last week we talked a lot about the crypto stocks. And even though the markets have not done well, coin has. And big breakout on coin. In fact, we talked about it a couple weeks ago, and it's like below the 200. In the next session, it broke above. This pattern here of a pullback and then a big green bar on Friday, to me, is encouraging. And I saw a lot of that when I looked at stocks. What else is in this complex? Hood, Robinhood. They're the broker most closely associated. There's your green candle, gap up, flag. Robinhood looks good. How about Bitcoin miners, Mara Holdings? Not so good. Ran up as we thought it would, but it came back despite higher. What about Riot in the same group? Big green candle, hammer off of the 17. So there's a lot of nice looking charts, even though the market's been pulled. These are big pullbacks, but they look like they want to reverse. So lastly, I'm going to go into my watch list and show you some of the things that I thought looked interesting and why. Aflac is insurance. Insurance is one that does well in the setting of, uh, of rising rates. A breakout above the 50 with momentum, decent volume, not extended, relative strength and OBV look good. Boring, boring, boring picture, boring story, nice looking stock, nice looking fresh breakout. I can't buy this because I'm a cancer doctor, but similar story, uptrend, pullback, just a breakout over the 50. British Tobacco pays a big dividend, big volume, breakout momentum, not extended, good RS and OBV. These are things that go up when markets do bad. Kava, I haven't eaten at one, but I want to. Big gap up on earnings. They had great earnings. 36% beat, but they came back to earth as the market sold off, but it stopped on the 17 and had a reversal on Friday. We talked about CMF. Discovery is another, as a credit card, another financial story. Again, flagging here, I'd be waiting for a breakout. I talked about ET as the MLP that I'm in, and this might be giving us an opportunity after a big move up, after, of course, earnings, which they didn't beat. But look at the green dots coming in before earnings. This was an interesting time, but I wouldn't have bought something right before earnings without more information. What's my edge? I think that one wants to go higher. Flutter. Didn't know what they did, and I found out that they are in the betting game, sports betting. Looks great. Is it extended? I don't know because it doesn't have enough days trading to have 200 bars look back. So yeah, it's extended. You can tell that in the chart. Home Depot, Lowe's has earnings. I believe Home Depots are out. A little bit of a beat. Uptrend pullback, breakout, a little bit of a flag. I like that. Hut is another miner. This one has not pulled back nearly as much as Mara. Prudential Financials, another in the insurance, kind of chopping around here. Root is a technology play or something in the insurance business. Had a major move on earnings. It's an IPO, a recent IPO, but enough to give me a high jump. Um, I don't know why they call it minus 237. They're supposed to lose 98 cents. They made $1.35. That caused a massive gap and it keeps going. I don't know if that's the old Quilmaji episodic pivot time, but that one is one that I'm interested in. SoFi, um, great move up in a pullback. Wait for it to break out of the flag. Square, Block Inc., an acquirer, I believe, and a participant in the Bitcoin story, pulling back in a big reversal day on Friday. We looked at T. Toast is one we talked about here several times. Gap and run after earnings, 7 cents versus a penny. All you got to do is go out to eat and you see their device all over the place. Western Midstream. Here's an MLP that's not overbought. Um, I'd like to see it break above the 50 with some momentum, but it was one that wasn't extended. Wally Mart has earnings this week, so that would tell me to be careful. But what a beautiful move on Walmart. WTTR, a lot of these water utilities showed up on my list, much more than I usually see. So hard to buy it after that move, which was, of course, on earnings where they 15 cents versus 14, giving us a flag. But breaking out of a flag, I learned from Ian that you take the pull, which I guess is from 10.40 to 14.20, $4, that you would expect when it breaks out to capture back $2 or $3 from the breakout point on a $13 stock. That's a lot. And then Zim, be careful of. This is one that has been a high flyer of late, a shipping stock. Its earnings have collapsed. They did really well during the COVID shortages, paid some massive dividends, but this one has been working as well. So, looked at a lot more stocks than I normally do, especially considering I'm not even bullish buying on Monday. I think we're at a bounce area, whether we bounce on Monday, have an intraday reversal after a big day down, and then it goes higher. That's a possibility. NVDA earnings on Wednesday would be the next event that could turn this market around. So I'm not jumping in on the short side. If we just continue to go down, that means I'm going to get rid of my short-term holdings and start looking to the downside and start protecting my longs. But right now, I'm still pointing long, raise cash, and sitting there waiting to see what happens over the next couple of days. Something I learned from my friend John Person, great educator, trader. If you don't follow him, personsplanet.com, he's got awesome tools. So I learned from him a long time ago. If Monday morning we have a massive sell-off, with the day we had on Friday, it would not surprise me. Don't wait until the market opens to turn on your Thinkorswim platform or your TradeStation platform or whatever you trade with. Once the market opens after a massive move, sometimes it's hard to get in. And I found it's better to have my platform on and ready instead of trying to start after open hours. Have a great week in the market. Join my group at Top Down Trader. Again, no charge. You can always quit. No commitment to buy or pay for anything. And I'll see you in Stocks and Docs on Tuesday morning.